and we're actually going to be talking about Jed's refinancing with Kasey Wong of about $20 million. So we're going to walk through the process, the thought process of how we take our investments in our big portfolios and we actually service those debts and service the financing across a time horizon of ownership. So I'm really excited to ask Jed some questions here and really find out how we got to this position of being prepared to refinance that size of a portfolio and what that really means in terms of take home and future investments with the proceeds of that. Alrighty, everybody, welcome back to the Canadian Real Estate Channel. My name's Adam JD Martin, and today I'm hosting a really special video for you guys. I've actually got Jed here from the Kasey Group, and we are going to be talking about refinancing multifamily real estate in Canada. And we're actually going to be talking about Jed's refinancing with Kasey Wong of about $20 million. So we're going to walk through the process, the thought process of how we take our investments in our big portfolios and we actually service those debts and service the financing across a time horizon of ownership. So I'm really excited to ask Jed some questions here and really find out how we got to this position of being prepared to refinance that size of a portfolio and what that really means in terms of take home and future investments with the proceeds of that refinancing. So Jed, welcome to the Canadian Real Estate Channel. Give yourself a little introduction and let's hear about this big refinance.
Well, thank you very much for having me on here. It's definitely something that I have been doing. Refinancing has been something that I've been doing since day one, ever since we started the real estate journey. So as I said, every property owner will at some point run into a situation where they want to refinance, whether it's a single family home or a bigger properties. So what I wanted to talk about today is really the thought process of how, when we start thinking about refinance, how do we choose, what type of refinance products that we wanted to put on our properties, who do we want to deal with, and what do we end up, I can give some examples. What do we end up choosing? And so on and so forth. And then in the middle of it, we can kind of dive into a little detail here and there. But what I wanted to get out is just a high level thought process.
Yeah, that's awesome. Why don't we start with the actual portfolio itself? So what did we refinance?
Yeah, so in about 2021, towards 2020 and 2021, we realized there's certain properties that are up for renewal. But usually when we look at refinance, we have to think about 6 months in advance at the minimum. I usually give it a thought, start thinking about it a year in advance, just so that we know, okay, we got to get ourselves prepared for the refinance. Depending on what type of refinance products that we want to go after, you always want to beef up, boost up your NOI, your performance, making sure that in the past 3 years, your performance has been going stronger and stronger each and every year. And also, what's the future plan? And when I think about the preparation time frame of about a year, time just go by so quickly. By the time you realize, you have to start picking up a phone call, it's about 6-7 months before the refinance, the original loan is up. So that's when you want to pick up a phone call with with the lender that you think you'll be interested in refinance our properties. Start chatting. What's the landscape, the refinance landscape? What are they looking at in terms of interest rate, in terms of loan to value, the appetite, and some lenders they only look at deals that are over a certain dollar amounts. So as you get more familiar with your loan products that you need for your property, you'll end up talking to a handful of direct lenders. Typically, if it's a bigger deal, I like to go with our direct lenders. I don't like to go with brokers, just because I can, I already have the relationship and I don't want to have to pay the 1.5% broker fee, or even like 0.75% broker fee.
So there's a couple things to unpack there. First thing you mentioned there was performance. So what are some of the key metrics you're actually going to be looking at in terms of the performance of your asset in order to prepare for that, for that 7 months you were saying was kind of the time frame? So what are some of the main things that you're going to focus on? Is that really just turnover, or is that cash flow? What are the basic fundamentals that we should be really generally concerned about before we go and apply for that refinancing?
Well, so when you go refinance, you typically have been owning the property for some time. When I say some time, I'm looking at typical multifamily rentals. You should already have about 3 years, 2-3 years at the minimum of running the property. And you know how the property performs, and you want to see the rent level has, it's improving, and you want to make sure that your NOI, it's also improving as well. Your NOI means net operating income improving. So that could, it could be the revenue going up, and at the same time, your expenses going down. They also want to see how your rent roll performs. And then they will apply a DSR, which is debt service ratio. But before I get into the nitty-gritty, you first have to look at how long do you want to hold the property? What's really your objective of holding these assets, right? Is that for just a medium term for the next 3-4 years, or is it for the long term, right? Do you want to extract cash flow from this, or do you want to extract the most equity out of the property and then reinvest? So what is the objective? Because that dictates what type of loans you are going to go after. It could be a conventional loan that gives you the more flexibility, but at the same time you expect higher interest costs. Or is it like CMHC type of product where you're going to be locked in for a good period of time, but you enjoy the lower cost of borrowing? Or is it simply just a turnaround? You want to, get the most and then you sell, right? Some people, they just want a 2-year, maybe you hold it for 3 years. You just want another to get some equity, putting it into another investment, and knowing that in 2 years, 2 or 3 years, you want to sell. And you're basically banking on the property going up in value then in the short term. So you don't mind taking that risk. So first off, knowing what you want to do with the assets. And then that dictates the term, the type of loan. As I said, do you want a loan that's give more flexibility with your like prepayment or like early breakage fee and all that? Do you want interest only, right? Or PNI, like the principal and interest combined? The type of lenders, you want a conventional like banks, credit unions. What kind of loan to value do you want to extract from the property? CMHC, you get like your First National, MCAP, and these are the typical ones. You have some CMLS. Those they're brokers, but they're also the ones that can help you to connect with the CMHC product. Or is it a private lending? Right, you can go to private lenders, and there are some bigger private lenders you can go after the MIC, and those ones typically you want to go with a broker because then they know they have a wider range of lenders that can offer that. So because our strategy is more long-term hold, when we want to go refinance, we typically want a long-term hold for cash flow reason, and I know exactly how long I wanted to go for at the minimum. Usually is if the asset still presents itself a good opportunity to increase in its value and also the cash flow, then I go for 10 years. I remember all these loans that I'll say, well, we've done four loans now during that time period. 3 out of 4, they're all 10 years. Just for the fact that we knew exactly how long we want to hold these for. These are long-term and good assets. Now, there are assets that you may not want to, it's good to hold, but for medium term, you can go for either. You can go for CMHC or go for conventional. But today's market is the sentiment from conventional banks has always been they don't care about the market price anymore. They want to go with your DSR. How strong is your building performing? So even though, let's say, for example, your building is worth, they say $10 million, the market can if you're going to bring it to the market to sell, you can fetch $10 million, but the bank will scale back, because if your cash flow can only sustain, let's say, $7 million valuation, then that's it, right? So they will only give you, let's say valuation is 7 million, then they give you 65% loan to value. So it's today, I would say the lenders are a little bit more conservative. CMHC on the other hand has also been, I would say they have loosened up a bit. It's sort of the opposite of the conventional lenders. They've loosened up a bit. They've provided a bit more favorable valuation for the borrower, and also stretched the dollar further. And when we locked in our rate, it was still during the lower range of the bond rate movement.
Yeah.
So we had some loans that are like in the mid twos, which is phenomenal for the next 10 years.
Yeah, that's incredible.
But all in all, what we would have to say is you have to be prepared. You can't just pick up the phone and say, hey, you know what? I need it for the next, I need to refinance in the next 2 months. Like, no way you would be able to do it.
Yeah.
Especially for CMHC product, there's no way. I know there's a backlog of about at least 4 to 5 months.
Yeah.
Right. So that means if I'm working backward time-wise, you really need to start picking up a phone call around 7 months ahead of time.
And how important is it to have your performance should already be where you want it to be at that 7-month pre-period, right? So you want to have your performance essentially where it needs to be, or are you allowing for a turnover and decreased expenses in that all the way to the point of refinancing? Like at what point are they looking at your performance? They're going to look right away. Yes,
good question. Exactly. So when you submit the whole package, and that includes your performance up until then.
Yeah.
There will still be this lag, as I said, for let's say 6 months lag. Towards the end of close to the funding, they will ask you for a up-to-date income statement. So to see if their assumption still applies. And then they will also want to see your up-to-date rent roll. If you see there's some more vacancy, then they're like, okay, maybe they will start having some holdback. Or they will want to say, the only reason why we will give you this loan is because of these vacancy not being there. So it is definitely paramount to have these vacant units to be leased up in order to guarantee to have that loan. Otherwise, it needs to be scaled back. So it's happened. So we were able to, fill those vacancy, and on funding, we were able to, take the whole loan amount. But if you can't, then they scale back. That's essentially how they work.
Yeah, but that's not the worst possible outcome, right? Because what you're suggesting is they'll do a holdback rather than just decline your entire refinancing, right? Because it's obviously just a portion of the performance that they're in frustration about, and so you're still going to technically be able to refinance, just potentially not as much until you fill those vacancies, which, in this market shouldn't be that terrible.
Yeah. So the thing is, it's not necessarily a temporary holdback. It's actually scaled back on the loan amount. So that means
the full amount.
For the whole period, that's all you get.
Okay.
So to the extent that let's say you depend on, I don't know, let's say you depend on the $500,000 to come in. Well, it's up to you whether you want to get that and for the next 10 years, right? Yeah. And so you work really hard to fill those units.
Okay, so that's extremely important. Make sure those units are filled then. So can you just walk us through your particular strategy? Like, what loans were you refinancing? Was it that you were exiting private financing, or were you exiting higher interest rates, or were you simply just trying to capitalize on the improvements that you've made to the property and the value that you've added? What was sort of your specific improvements or reason to actually go ahead and do this refinance where you're getting the proceeds of about 20 million?
Yeah, so I'm going to give an example of just one cluster of the buildings. We actually this is our second time refinancing it. So the first time we refinanced in a third year mark, and then the 2.5 years we refinanced again with the CMHC. The first one was simply with the conventional. When you typically, because we focus on value add type of properties, on day one, we never lock ourselves in a CMHC. And also back in the days, CMHC also wouldn't look at any kind of value that you put in, or they will look at that time, day one performance. And if you put in that day one, the performance, it's really lock yourself up. So we went with the conventional with the bank. Although the cost of borrowing is higher, we knew that we were able to, improve the operation. That means improve the cash flow and so on and so forth. The second time, so that was on purchase, and then on refinance, we also felt that we still have a lot of room to grow for the next 2.5 years. So we didn't go with the CMHC either. We went with the conventional with the same lender, but extracting a bit more to reward what we have done up until that point, knowing that there's still much to do in the next 2.5 years. Now, fast forward to late 2020, early 2021, we knew that the assets is completely stabilized, but based on the economic conditions of a broader economy, we know that the buildings definitely still has a lot of leg to go. But we didn't want to go with the conventional just because all the heavy lifting has been done. Now it's more a little tweaking here, a little tweaking there. So we locked in with CMHC for a long 10-year loan, knowing that this is a good hold. And we capitalize on that, capitalize all the improvement we've made, and then have excess the equity. I'll call just extract some of the equity out. But more so, we lock in those costs, the cost of financing for the next 10 years. So regardless of where the rent goes up to higher level, it's just more money in our pocket.
Yeah.
Right. Like we already have a baseline to go by. So the fact is, where we were at the time, it's already enough to pay the loan for the next 10 years. So anything that goes, that's at the bottom line is gravy. Yeah. So that was the whole rationale of let's go with a CMHC, knowing that the property is something that we like to hold for a longer period of time.
And how much of that would you say is your emotional or personal investment needs versus market conditions or environmental factors?
I don't go with my emotional needs. Yep. These are all LPs. Like these are the properties that we manage with, have investors involved. So yeah. I never go by emotion. It's always looking at, okay, our loan is coming up. Is it worth to, what is the plan for these assets? And what is, if I don't do it today, when am I going to do it? Like knowing that my loan it's coming due a year ahead. So my loan is coming due. I need to figure out the game plan. And what's the game plan? Is to sell? If it's to sell, then we don't have to worry about it. But it's very much a business case. Nothing to do with emotion. As I said, you always have to look at the asset as with an objective mindset. So that's very different from if you were to do, a single family home rental, because it is so emotional. It is your own. But for me, this is a business. And therefore is all business case.
Awesome. Yeah, that totally makes sense to me. And I love the idea of going into the property with the long-term plan being figured out, right? It's kind of having the answers to the test before you write the test. It's like, what is the best product for us to maximize our opportunity with this project, with this property, long, short, medium term, and then just take, decisive action. One question I did have about the, as you were speaking there, I was kind of wondering about direct lenders. How do you build these relationships What's the best strategy that you found for shopping these direct lenders? Like, are you talking about like literally calling a business development manager or somebody like that at Scotiabank, or name any big bank, or are you finding other ways of getting in contact with these people? How did you go about sourcing?
Well, I mean, if you're starting out, it's definitely difficult, and you have to rely on brokers. Some deals I still rely on brokers because I just for smaller deal I didn't want to. I would just hand off to brokers, too much work for smaller things. But it is through years of networking, and as you grow your portfolio, you'll meet different people, and that's how and then they will come to find you. And believe it or not, they will come to find you. And I would say the people that you build a relationship with, they don't necessarily stay in one place, right? So some people will stay, let's say in BMO, and then a few years later they go to TD. You go with them,
Yeah.
right? And but you still have existing relationship with your, let's say, BMO, right? And sometimes they, like on LinkedIn, for example, right? So you know that you are, you put up your business profile, you put up who you are and what you do, and you're being active there. Then they will come and find you. It's I don't know. I can't pinpoint where. I go to conferences, right?
Yeah.
So I've been to conferences where I was sitting next to a gentleman who works at MCAP.
Yeah.
Right. And then we start talking, and then he found how I saw your profile and blah, blah, blah. And so then you start talking, right? The main thing is for direct lend, I like to deal with direct lenders because I know what they're looking for. But at the same time, it could hamper your ability as well, because sometimes the different lenders have different criteria. Yeah. And you don't know, you wouldn't let's say I have for example, there's one time I have a property that I need to refinance, a small property. I need to refinance for, I think it's just under 2 million. And it's a small deal, super small deal. All the people that I talked to, they didn't even want to entertain. It's a small deal. So in that case, I went with my broker who I know really, really well. So I say, hey, can you help me out on that? And he was able to connect me with a smaller credit union. Now I have a contact with a credit union, right? So from there, I'm not trying to supersede my broker. I still recognize that he's the one who brings me in. But at the same time, you also wanted to build a relationship with the person who's at the financial institution who's doing your deal, right? I never go over someone else's, go over the referral. So never go and screw around with the brokers, because they are a good source of funding too.
Absolutely. Well, it sounds like networking has really been a big part of getting you from where you started to where you're at today. I mean, a $20 million refinance is fairly significant, I would say. I mean, that's about $20 million more than I've ever done. So,
well, not that. I mean, the loan is just more zero at the end of the day.
Yeah. Now that you've done this $20 million refinance, does most of this capital go back into acquisitions, or is this eliminating certain partners or certain high interest debt? Like, what is the actual purpose of doing a refinance of that scale?
So for us, it's about continuing on with our business plan for these assets to replace the existing loan with a higher loan, but not excessively high. And the excess is to purchase more, to acquire more property, and we have successfully done so, to acquire more property within the REIT. So in a way, it's not necessary to cash out. So one of the things about CMHC loan is that they have changed the rule, right? So they no longer allow you to strip equity with refinance. So the refinance amount has to be reinvested into further asset development, acquisition, or just the improvement to your existing property. And you have to prove that. So that's out. But if you were to go with conventional, there's no such limitation for you. So for us is to acquire is really for expansion plan within our Kasey group, particularly with our introduction of our private REIT. That was the game plan that we planned out, a year or 2 years ago.
Excellent. No, that's fantastic, Jed. And it's been really exciting to do this video with you because I've really started to realize sort of what the top takeaways here are for anybody that's looking to refinance on this scale. Really, the focus of your strategy is setting ahead long enough. Like you've got this big lead time if you actually want to do this successful. You mentioned it's about 7 months. And then the other thing,
that's a minimum.
Minimum 7 months. So 12 months, maybe 12 months is the ideal then. Yeah. And what we're actually going to go for and focus on during that 12-month period leading up to it is actually just improving your performance. And you're really focused there on debt service ratios and really the relationship between your revenue and expenses and what's left over at the end of the day. And the fact that there is this situation right now where it's quite possible or even probable that your asset may be worth more on the market than what the bank is willing to stake as collateral. And so I think that's an important relationship to talk about because, we've all seen what's happened to real estate prices over the last 5-10 years. They're going insane, particularly in the bigger markets that I think you might be investing in, like Toronto or that general region. And those markets, the valuation has just gone sky high comparatively when we're looking at rents and stuff. And I'm with the bank on this. I think you're better off to collateralize a lower amount than a higher amount because it is quite possible that these prices can change in the future, right? They can go down. Maybe they keep going up. We don't know. We don't have our crystal ball here on the Canadian Real Estate Channel. But I think it's smart for the banks to do that so we don't run into 2008-like problems where there is no actual collateral or value left over at the end of the day relative to your loans. The other thing that you mentioned was the importance of networking and going and building these relationships with the direct lenders, but also with brokers and other service providers that can help you begin those relationships and actually establish those relationships so that as you develop your portfolio and find yourself in the position of doing a $20 million refinance, you actually know the people to call. You actually know who can potentially help you out and offer you that broader range of products so that you can figure out what product is actually best for you and your needs at that time in order to best service that asset in the long term. So I think those are my top takeaways from this video, and I really appreciate you coming on. And that's Jed, guys, from the Kasey group, and she's going to actually be coming back on a future video to discuss with us the differences in investing in Canada in 2022 versus maybe how we used to invest or were investing even in the last 5 years. Things have changed in our market, and that's going to be the next video where Jed comes back onto the Canadian Real Estate Channel to actually walk you guys through what's different today and what's maybe some of the outdated information you might have been watching, even on our own channel, right? We've been producing videos on this channel for years now, and some of that information is changing. In fact, it's changing all the time with different financing rules, different market conditions, and just different ways to invest. So I'm really excited to have Jed back. Make sure you guys come on back, tune in, turn on the notifications, like and subscribe. You know the deal, so that you can get that next video with Jed from the Kasey group. So thanks, Jed, for coming on today.
Thank you very much for having me.
Awesome.